You check your bank account, it looks fine. You check your credit score, it looks fine too. And yet, somewhere between those two numbers, there might be a debt that neither one of them can see. Sounds impossible, right? A debt that's real, that you owe, that's quietly stacking up every month, but invisible to the systems built to track it. It's not a glitch, it's not a conspiracy, it's a payment method most people use without thinking twice, and the numbers behind it might surprise you. Before we get into it, if you've ever clicked 4 payments of $25 at checkout without a second thought, you're going to want to stick around for this one. And if this is the kind of thing you like understanding, hitting subscribe means you won't miss the next breakdown. So let's start with the obvious question. What is this hidden debt exactly? It's buy now, pay later. You've seen the button. Split your purchase into 4 easy installments. No interest, no hassle, just tap and go. It feels less like debt and more like a convenience feature. But here's where it gets strange. For years, most of these loans were never reported to the 3 major credit bureaus. Not Equifax, not Experian, not TransUnion. On-time payments didn't help your score. Late payments often didn't hurt it either. The loan simply existed in a kind of financial blind spot. Lenders evaluating your mortgage application, your car loan, your next credit card, couldn't see it. You could be carrying 5 or 6 of these installment plans at once, and on paper, you'd look like someone with no debt at all. That's the phantom part. Real money owed, invisible on the documents that are supposed to capture your financial life. And according to research cited by the Richmond Federal Reserve, this gap between what people actually owe and what shows up in official debt statistics has grown large enough that some economists now treat it as a genuine blind spot in how we measure household financial health. Let's pause on that for a second. The people whose job it is to track the financial health of an entire country may be working with incomplete information. Not because they're careless, because the data genuinely isn't there yet. Now, how big is this really? Estimates vary depending on the source and the year, but tracking from LendingTree's 2026 survey data suggests that the share of buy now, pay later users who paid late at least once in the past year jumped from around 34% to roughly 41% in just 12 months. That's not a small shift, that's a 7-point jump in 1 year. And it's not just clothes and electronics anymore. The same tracking found that something like 25% of users are now using these installment plans for groceries, nearly double what it was a year earlier. Sit with that for a moment. Groceries are not a discretionary purchase you can return. You eat them, they're gone within days. So when someone finances a grocery run into 4 payments and then falls behind on that loan, they've effectively paid extra in fees and stress for food that's already digested. That's not a shopping habit. That's a sign that the monthly math isn't working. Why would so many people end up here? It probably isn't about carelessness. The Consumer Financial Protection Bureau's own market reporting has pointed to something simpler. Buy now, pay later tends to concentrate among households that are already financially stretched, younger borrowers, lower incomes, thinner savings buffers. In other words, the same people who, according to surveys like Bankrate's annual emergency savings research, often can't cover an unexpected expense in the few $100 range are also the ones financing everyday purchases in installments. That's worth a question. If someone can't absorb a surprise expense, and they're also splitting their grocery bill into payments, what happens the moment something actually goes wrong? A car repair, a medical bill, a reduced paycheck. There's no slack left in the system. The buffer was already gone before the emergency even arrived. Here's where the story shifts, though, because something changed very recently, and almost nobody talked about it outside of finance circles. Starting in 2025, some buy now, pay later providers began reporting these loans to credit bureaus. Not all of them, not consistently, but the shift has started, and credit scoring models, including FICO's newer scoring approach, are beginning to factor this kind of installment history into your score, which means the invisibility that made buy now, pay later feel low stakes for years is starting to disappear. A missed payment that used to vanish quietly into the void can now sit on your credit file the same way a missed credit card payment would. If you've been treating these plans as separate from your real credit, as some kind of side ledger that doesn't really count, that assumption may no longer hold. And this is where the human side of it gets interesting, because surveys consistently show a strange contradiction in how people think about this. According to consumer research from Numerator, around half of buy now, pay later users believe these loans help build their credit score. In reality, that's only been true in a narrow, recent set of cases, and for most of the product's history, it simply wasn't true at all. People weren't lying to themselves on purpose. They were reasonably interpreting a product that looked and felt like a modern, harmless convenience. The marketing leaned into ease. The interface looked nothing like a loan application. There was no intimidating paperwork, no stern loan officer, just a button that said split it into 4. That's the design genius of it, and also maybe the trap. When debt doesn't feel like debt, people don't manage it like debt. So where does this actually leave someone, sitting at checkout, staring at that 4 payment option? It's not that the tool is evil. Used deliberately, for a planned purchase, paid off on a fixed schedule, with money you already know is coming, it can function like any other short-term financing tool. The danger isn't the existence of the option. It's reaching for it as a way to bridge a gap that income alone can't close. Debt, in almost every case, isn't really a moral failure. It's math. If someone is financing groceries, it's rarely because they don't understand basic budgeting. It's because the income side of the equation isn't meeting the expense side, and short-term installment plans are the most accessible way to soften that gap in the moment. That reframes the whole conversation, doesn't it? The real question isn't, why are people making bad choices at checkout? The real question is, why does covering basic groceries require a loan in the first place for a growing share of households? And that points back to something bigger than any single spending habit. Inflation data from the Bureau of Labor Statistics has shown persistent increases in the cost of essentials, food, energy, and housing among them, even as overall price growth has cooled in some categories. When the cost of staying alive rises faster than paychecks do, something in the household budget has to flex. For a lot of people right now, that flex point is showing up as 4 small, easy-feeling payments instead of one larger, harder one. So if you've used one of these plans, this isn't a lecture, it's information. The actual signal worth paying attention to isn't whether you've ever used buy now, pay later. Almost half of American adults reportedly have at this point. The signal is whether you're using it because it's convenient or because you genuinely don't have another way to cover the purchase right now. If it's the second one, that's the moment to look at the bigger picture instead of the next checkout button. A real budget review, a look at recurring expenses that have crept up quietly, an honest count of how many of these plans are currently running at once, because most credit tools still can't count them for you. This is also, probably, where the conversation about personal finance needs to grow up a little. For a long time, the advice was simple: avoid debt, build an emergency fund, don't carry a balance. That advice still matters, but it was built for a world where debt looked like a loan application and a stack of paperwork. It wasn't built for a world where debt can look like a single tap, broken into 4 invisible pieces, spread across 5 different apps, with no single place that shows you the full picture. The tools changed. The advice mostly hasn't caught up yet. There's another layer to this, worth pulling apart, because it isn't evenly distributed across age groups, and the pattern matters. Younger borrowers are carrying the heaviest load here. Some industry surveys have suggested that close to a third of Gen Z buy now, pay later users are financing groceries specifically, and a striking share of that same group, sometimes cited above 7 in 10, are juggling multiple installment plans at the same time. Not one, multiple, running in parallel, each with its own due date, its own app, its own small automatic withdrawal hitting a checking account that may or may not have the funds ready on that exact day. Why would that be? Younger adults are often earlier in their careers, often carrying student debt, often facing rent and housing costs that have outpaced wage growth for years. Buy now, pay later didn't create that gap. It just became one of the easiest ways to paper over it, purchase by purchase. And there's a regulatory piece of this story too, one that quietly shifted the ground underneath everyone using these products. For a while, there was momentum toward treating buy now, pay later more like traditional credit, with stronger disclosure rules and consumer protections attached. Then some of that oversight was pulled back. The result is a market that's growing fast, reporting practices that are still inconsistent from one provider to the next, and a regulatory picture that's arguably looser than it was heading into this just a year or 2 ago. So you have rising usage, rising late payments, inconsistent reporting, and lighter oversight, all happening at the same time. None of those 4 trends alone would necessarily be alarming. Together, they start to look like a pattern worth paying attention to. There's also a quieter psychological cost buried in here. separate from the dollars and cents. Survey data from Numerator has found that close to a quarter of buy now, pay later users say they feel stressed often or always about upcoming payments. That's not a number about default rates or credit scores. That's a number about how it feels to lie awake doing math about 4 small charges spread across 4 different days, each one small enough to ignore on its own, all of them large enough together to matter. That stress is real, even when the dollar amounts involved look small on paper. A $25 installment doesn't sound like much. 5 of them, due on 5 different days, against an account that's already thin, is a completely different experience to live through. So here's the one thing worth taking from all of this. Not delete the apps. Not never use installment payments again. Just this. If you're currently running more than one buy now, pay later plan, take 5 minutes this week and write every single one down in a single place. The amount, the due date, the provider. Because the moment they're all visible together, in one spot you actually look at, the invisible debt stops being invisible. And that, more than any single budgeting rule, is usually the first real step back toward control. We started this video talking about a debt that doesn't show up anywhere. Maybe the real takeaway is simpler than that. The most dangerous debt isn't the one you can't pay, it's the one you forgot to count. If this kind of breakdown is useful to you, there's a lot more like it coming, including a closer look at exactly how hardship withdrawals from retirement accounts are quietly hitting record levels, and what that says about how prepared most households actually are for the next surprise expense. Subscribe if you want to be there when that one goes up.